All right, in terms of underwriting standards by the bank, these are generic, so these comments are all generic, so every bank has, and I'll talk about the LVRs in a minute, what banks will lend to what levels, but in basic terms, the customer underwriting standards is the policy will allow super funds purchase of residential property for investment, purchase of non-specialised commercial property for investment. So let me just explain what I mean by non-specialised commercial property. Simply, the areas in commercial that the funds and the banks will look at is office space, retail and factories. All right. There are a whole lot of other commercial properties such as aged care, retirement homes that people look at, but that's really the banks stay away from those. So the only real, if you're talking in the commercial space, office space, retail shops and factories are the main three commercial areas. Purchase of non-specialised rural properties for investment, and refinancing of loans for investment properties acquired after September 2007. I was at a similar meeting last week, and a gentleman in the audience was adamant you cannot refinance a loan under your self-managed super fund. That's incorrect. You can, if you find the right bank. Not all banks will do refinance under self-managed super fund. So you can, if you have a current loan with a lender under your super fund that you're not happy with, you can shop that around. But again, your level of option is limited. Out of the 13 residential banks that the 13 banks that I use in the residential space, probably only about 5 will refinance, the others won't. On the flip side of the coin, the policy specifically excludes transactions under the SIS Act, so non-commercial related party transactions. Investments into non-income producing or going concern, vacant lands, hotels, you can't buy them under your super fund. Finance or reliance upon the development or refurbishment of the investment asset, so basically property development. Generally property development is a no-no, but if you speak to a smart legal person that can set up trusts and put a particular entity in place, or a tree structure, you can actually get around that development under a self-managed super fund. I'm not a solicitor, so I'm not the one to answer how you do that. But I know you can do it because I've seen it. Need to be at arm's length transactions. This is a regular question. What if I buy a 1-bedroom apartment down in Richmond and I want my daughter to live in it, and I'm buying it under my self-managed super fund? No, you cannot. So under a self-managed super fund, the tenant in that residential premises and or commercial premises for that matter that's incorrect. Under the residential side of lending, you cannot put a family member, so that it has to be at arm's length. Property development or house and land packages are also excluded, and loan increases or cash out, which are a typical loan feature of any investment or a home loan, that you cannot get cash out on a self-managed super fund, and people do try to do it. People want to get money out to buy shares, for instance. Within their super fund, you can't do it. You can't get cash out on a loan that's under a super fund. All right, this slide's probably more specifically for commercial space, and what the lenders will actually look at when they're reviewing. So the commercial lending risk is risk priced. So quite often in the commercial space, you'll ring a bank up and say, okay, I want a quote, I want a variable rate quote today, and they're already gone down yesterday. I think Westpac have gone down 28 base points, didn't they, overnight? So the banks are moving quite surprisingly very quickly for a change. But on the commercial side, quite often you will get a quote. If it's a variable quote, it'll be something like 7 to 8%. And you'll say to the person on the other end of the phone, okay, can you give me something a little bit more definitive? And they actually, most of the time on commercial purchases, won't do it, because they actually need to go in and have a look at the property and look at the borrower and actually risk rate that particular transaction. The better the risk, the better the rate. The worse the risk, the worse the rate. They obviously look at the overall lending, customer rating, financial position. The industry certainly does come into it. in terms of the type of commercial property that's being purchased. Valuations, location, who are the tenants, term of the leases, weighted average of lease of expiry. Servicing, I just want to come back to this one, term of leases. One of the things that you won't find out when you talk to a bank, if you don't go to a broker and talk to a bank, they won't tell you this. If you take out a commercial property and let's say the office across the road, and I take out a 5-year lease, so I'm an accounting, in fact I'm doing one this week in Ringwood. An accounting firm's buying a new office, they're going into it, and they've taken out they'll be the tenant, and so they will pay the Superfund the rent. They're taking out a 5-year lease. Some sneaky banks out there will tie the term of the loan to the lease term of the office space. So, which means if you take out a 5-year office lease, the bank will then say, we'll make the loan 5 years. What happens at the end of 5 years?
Nightmare.
Nightmare. Not just a nightmare, but cost. They're going to roll that loan over and they're going to slug you about another $3,000, $4,000, $5,000 to do it for the privilege. And in the case of the client I'm seeing later this week, they're buying 2 office space. So 2 separate, buying it under 2 separate family super funds, so they'll have double the cost, double. So one question I always ask, and I always get it in writing from a bank, you will not link the term of the loan to the term of the lease. Always ask them that question. It's one of those things I'll slip through and you won't see it if you don't ask. Servicing. Generally servicing, it's a little bit different to, someone comes to me and wants to buy an investment property and I look at their income, work out what the servicing is. Each bank has its own servicing model. Basically with self-managed super funds, it's a little bit tougher, but they look at your contributions, and if you're buying an investment property, obviously you're going to have rent. So it's your contributions and your rental income, and predominantly if you want to work out whether you can afford it, work on the basis of whatever your repayments are going to be for the loan, multiply it by 1.5, and that's what your income needs to be from your contributions and your rental income. So you look at the loan repayment, once you work out how much you want to borrow, whatever the loan's going to be, work out your loan repayment, multiply it by 1.5 and you'll be close to what the banks will be looking for to service that loan. On the rental income, some banks will give you 100% dollar for dollar for your rental, for your servicing. Some banks will give you 80 cents in the dollar. So once again, it's not the same right across the board. Every bank has its own lending model, and quite often it's the rental income that where people think they're going to get dollar for dollar. I've got a $1,000 a month rent, I'm going to be able to use that $1,000 a month towards repayment or servicing. Well, it's not, it's $800, and people get caught out there. Applicants' experience in commercial property management, term of lease, there it is there. Term of lease can be linked to the term of the loan, yeah. Product selection. This is probably about 6 months old, this slide now. So the self-managed super fund, the three products that the banks look at is the bank bill business loan, the business loan and the investment property loan. The investment property loan is pretty well your standard investment product that you get when you're buying outside a super fund. That bank bill product's probably being dropped now by most of the banks. So it's really these 2 products up here, the business loan for commercial purchase and the investment property loan for the residential. I'm not sure what that's referring to. I think it's on the next slide in regards to LVRs. Okay, I made a comment before. I don't know how many times people will come to me for the very first time to get finance under self-managed super fund, and they ask all these sorts of questions because I have 10 properties. I've bought 10 properties under my own name in investment properties, and I'm now buying my first one under self-managed super fund, and I'm expecting the conditions of the product to be the same. They're not. Things like redraw not available, offset not available. Although that's not entirely true. There's actually 2 banks are about to launch a product out there, and Macquarie's one of them, where you actually can put your money into their cash. Macquarie's probably one of the best well-known cash management accounts, and get a loan and offset it against their cash management account. But generally, offsets not allowed. Interest capitalisation not available. Increases not permitted. Holiday repayments not permitted. Now, the terms of the loans are normally for investment property just your normal 30 years, 25 years for residential secured by a business loan, or the standard 15 years for non-specialised commercial lending. So 30 years residential, 15 years for commercial. As touched on before, residential commercial, the net rental income from property investment and Superfund trustee income, your contributions and dividends. Now, I didn't mention dividends before because quite a few of the banks are now starting not to use dividends. The 3 income streams for servicing a loan were your contributions, your rental income and your dividends. I've noticed in the last month at least 3 banks have dropped dividends off their policy. So they're just going back to rent and your contributions. And no doubt Darren might cover some of that later on. Yeah, we're lending, this is for rural properties. I don't do too many, but we're lending against a rural property. The following must apply. Statement of position for the farming operators must reveal sufficient surplus funds and assets to cover current, potential future borrowings. The self-managed super fund must have fewer than 5 members. Anyone in the room got a self-managed super fund and owns a farm, operates a farm? Yeah? Okay. I don't do too many of them.